Hello and welcome to the market update for Tuesday, July the 20th. Obviously, we had the big sell-off yesterday, um, and if you go back and view the updates last week, we were talking about the potential for a pullback. Um, Now, there wasn't as clear a signal of a pullback that there sometimes is. Sometimes the clues are a little bit stronger. In fact, in one of the updates last week, I said, we're at a point here where, it really could go either way. We could break out and go higher, or we could have a pullback. I think a lot of that was due to the fact, this is also something I've been talking about a lot, that we weren't yet overbought in the market. And anytime you pull back from a non-overbought condition in the market, the chances of it being a bigger correction are lower because of the fact that you don't have that exuberance, that hyper bullishness that takes place when you really get overshot to the upside. And so that's why it's not too surprising that we kind of bounce back today. Although we're bouncing back on lower volume, that's something to keep an eye on. Sometimes you'll get these snapback rallies that on lower volume that end up rolling over. Now we'll look at the charts here in just a second. But typically you don't get these these quick drop corrections that go right back up again. But we've had a few of them in the last 6 months to where it would shock me if we go to new highs, at least in some of the indexes here, especially since we haven't entered that overbought state yet. But keep in mind that there's a couple things to keep in mind with this sell-off yesterday. One is that every time you have what happens when you have these sell-offs and the market rebounds is you get it emboldens the dip buyers. It makes everyone that feels smart that they didn't panic. They bought the dip and they made a lot of money as it rallied right back up again. And what happens is that they get overconfident. They feel like they know what the market's going to do. Any dip that takes place, you don't panic, just go buy it, and it works out for you until it doesn't. And that's what creates the panic, is that what's going to happen at some point, probably when the market gets stretched and really overbought, is we'll get one of these sell-offs. People will buy the dip, expect it to go right back up again, and then it won't, and that's what creates the panic. Now it's like, what's going on here? This has worked for the last year, that every time it's pulled back, you buy it. And that's what leads to those larger corrections, is that it creates that panic selling. You're not going to panic sell unless you're panicking. And you have to have something that creates that panic, and that's what creates the panic. So I'm not saying that you can't get caught up in that. One thing I often talk about is we want to try to understand the trading crowd, but we're also part of the trading crowd. We're also human, so we can be drawn into those same emotions. We're not going to be able to always be separate from them, but I think understanding those tendencies is important, so that you can recognize them when they start to take place, and hopefully trade against them. And we did that partly last week. The market was flashing some signals of a possible pullback, not strong signals, but enough to where some of the advice I was giving was it's not a bad idea to sit on the sidelines, to kind of sit out, wait, go to cash. And if you did that, then, if the market is going to rally from here, there's a lot of stocks that pull back pretty dramatically that could give you some good entry points. And we'll take a look at some of those today as we go through the list here. Now, as far as the direction alerts are concerned, we're still in kind of a tired market state. as I mentioned, anytime you have sentiment above momentum, and momentum is above breadth, it's a signal of a tired market. We've been in this tired market for a long time here, as you can see, and that's why that's not a signal. When you see that signal of a tired market, it doesn't mean that you're immediately going to get a correction or a pullback. It just is a recognition that things are things are, you're not in that explosive state of the trend when you see that, and so it's just important to recognize that, and more importantly to see if that changes in the next little bit. See if we start to see those shift a little bit. Now, the momentum indicator, remember a couple weeks ago we were right in the extreme range. We've moved all the way back to hold, mostly from that sell-off yesterday. I think we're in the buy range last week. So momentum is pulled back a little bit. Breadth has been in this trending area for quite a while, even when the other indicators were in the extreme range. This was down in this trending range. The breadth has not been real strong, but that's been one of the reasons why we were expecting a little bit of a pullback, was that we were seeing the market go higher, but there were fewer stocks that were pushing the market higher, and that's what you're trying to read when you're looking at these indicators. That was telling us, and it wasn't just in the indicators. I saw it with looking at a lot of individual charts, which I do on a daily basis. There's a lot of individual charts that looked terrible, but yet the indexes themselves, the S&P 500, the Dow, the NASDAQ 100 in particular, were all going higher, and in the case of the S&P and the NASDAQ 100 reaching new all-time highs, but yet there were fewer stocks that were fueling that move, and that's why we look at breadth. Is it can it can sometimes be that early indication of nearing the end of a trend. Fewer stocks are pushing the indexes higher. Sentiment again was extreme. It's backed off a little bit. It's in the complacency range here still, but it's still high. And again, a lot of that was just from the recent pullback. A couple other things to look at. The buy-sell ratios are kind of reaching an extreme range where the sells are outpacing the buys, but you see you have a pretty wide range there. Usually when you get that wide, it starts to come back together again, and we might be starting to see that with the rally here. And then the sentiment indicator right here. Again, anytime you get to this extreme range, you have to be worried about a little bit of a pullback. It didn't happen immediately, but we were getting to that extreme range, and it was telling us that we're in an area where we could see a little bit of a pullback. But since then, with that drop yesterday, the sentiment has dropped way down here. So we're not in that extreme area there. Let's take a look at our charts. I can show you what I was talking about earlier. So you can see the rebound today, pretty strong. Yesterday at the close, we were actually near the lows of the day with about 5 minutes to go before the market closed, and then we had a little bit of a rally into the close. And then I don't know if you're aware of this, but the indexes, the SPY, the DIA, the QQQ, the IWM, they continue to trade until 15 minutes after the market closes, and in that time we saw the indexes rally up even further, and so it changed the look of the candle just right at the very end of the market day. And and the reason why I'm pointing this out is because right at the market close, the indexes were looking pretty bearish. It looked like we were probably going to gap down today and or move lower today, and then they rebounded right there at the very end. And unfortunately, a lot of that movement happened after the market had closed. This is one of the kind of the criticisms I have of the way the market is structured is that obviously that was professionals that were doing a lot of that trading. And the point I'm trying to make is that the way the market looked at the market close was, well, I'd say about 5 minutes before the market closed was a lot different than what it looked like 15 minutes after the market closed. So there's not a lot you could have done to kind of deal with what that was showing there, the price action there. So it's kind of unfortunate because it went from looking very bearish to not too bearish, and maybe even a chance that we could rally today, which we obviously have done. So, but what I was pointing out earlier in the update is that typically you don't see sell-offs where they just drop and then go right back up again. Usually you get that kind of ABC pattern look to it. You get that initial sell-off, you get that suckers rally or that bounce, and then you get kind of a flush out move, and then you continue to move higher. Now this can take on different looks. It can be a little bit more choppy, but you get that stair step kind of move to it. But here we had just a sharp sell-off that rebounded right back up again. Back here, well, actually we had a little bit of a bounce. It came back down, but we've had a lot of these just really quick sell-offs that have just rebounded lately to where it wouldn't be shocking if this thing came all the way back up and broke out higher. One thing I did point out, though, is that we are kind of rallying on lighter volume. I know we have still a couple hours before the market closes, but that's going to be, obviously you would expect the volumes to be lighter than the sell-off day. I'm not expecting volumes to be as high as they were yesterday. But it is looking to be a little bit of a lighter volume day. But that, again, that doesn't necessarily mean that you can't still move higher from there, but that's something to keep an eye on. And also what I was saying before is that, again, we're not in an extreme overbought state. So, you could, going back to what I was saying, is you get these little pullbacks and they end up going higher, and it starts to condition the traders to think that that's what's always going to happen. And the reason why I'm pretty confident that that's taking place right now is I haven't heard anyone today on websites, on CNBC, everyone's talking about yesterday as being no big deal. We're going to go higher. Nothing's changed. Everything still is fine. Nobody's worried about that sell-off. And again, understanding human nature and understanding crowd behavior, that's a sign that we're building toward this top that's not going to end well when it finally does correct. Now, in the meantime, we can still trade what we're seeing. The trend is still up, and with today's rally, there's still trades we can get into to trade to take advantage if the market does go higher. I'll talk about some stop loss techniques today as part of the training that you can use to protect yourself a little bit, recognizing stop loss areas that you could consider. But it's also important to recognize the overall condition of where we're at within the larger trend. I'm not trying to predict trend reversals. I'm a trend trader, but I think it's what's very important. A part of being a trend trader is being able to recognize where you are within the trend. Are you near a top? So that you can, like I said, make trading decisions, whether it's tightening up stops, going to cash, and in some cases, trading the downward move. I had some trades I got into on Friday, put option trades. I took advantage of the drop yesterday. I made a good amount of money on that drop. It was just a kind of get in, get out type of a situation. But because I'm able to recognize that bearish reversal day we had on Friday, you can take advantage of that. So being able to recognize where you're at within the trend. And that's why I'm pointing out some of these psychological things that I want you to pay attention to. Usually when you're at a top, everyone's confident that things are going to keep going forward. And we're starting to really see that. And that helps you too when you're listening to these experts, quote unquote, on CNBC. If I'm not saying that they're not smart, I'm not saying they're not successful. Obviously, they're on the shows for a reason, but it doesn't mean they're always right. And sometimes you have to kind of be able to recognize when they're not right, or when they're kind of cheerleading the market, so to speak, and when you can trade against them. I just cringe sometimes when I'm looking at charts and I hear some of these recommendations, and I know that whoever's following those recommendations are about to lose money because they're not able to read price action or read what the chart is showing. And so that's what I'm hoping to do in these updates, is to teach how to recognize when some of those people are right and when they're wrong. All right. So that's the way the S&P looks. Dow. Remember, the Dow was very close to it had closed at an all-time high close, but it hadn't ever gone above the intraday high from back here. We'll see if it can do it, if the market can rebound and push higher with this rally today. Let's go back to the SPY here. The SPY kind of bounced off of a key areas to watch right here on the SPY. Here's a resistance area back here. And the intraday low from yesterday went right down to that area and bounced off of that. So there is a little bit of support in this area that could explain a bounce right here. Some of the other indexes, though, don't have that. There isn't a real strong support or resistance where they rallied. So the Dow is kind of one of those. It's, I would have looked at this as being a support area. This, well, I don't know, maybe a little bit from the intraday low got close to that support area. So I guess you could find a little bit of support there with the Dow. NASDAQ 100, though, not really. It did have a bullish reversal price action yesterday, a little bit of a hammer candlestick formation. But again, here's the next support level. Not really a support area right there where it's rebounding. And then the Russell, let me take the volume bars off here for a second. Let's go to a one-year chart on the Russell. You can kind of see it's near a support area. It kind of dipped a little bit below it, but you got a little bit of support in you got, well, actually a lot of support in this area right here. But another thing to keep an eye on is, again, the underperformance of the Russell. Russell tends to be a little bit more of a leading indicator. That's something to keep an eye on here in the next few weeks, is to see if the Russell, in the rally, does the Russell 2000 outperform the other indexes? That would be a good sign that maybe indexes are moving higher. If it still underperforms, it would be an indication not to be careful not to trust the rally so much. Because you should see that participation from the small cap stocks. Can everyone hear me okay? I just got a message here that the sound went out, and if everyone else can hear me okay, then it might just be that I can never tell if it's on my end or on someone else's end. Can everyone hear me okay? If someone could just let me know that they can hear me, that would help here. All right, I'm going to assume then that, okay, so it might just be that one person that was having trouble. Hopefully they can call back in and get the audio back. I didn't see anything on my. Usually, I'll get a little thing that'll pop up if the audio on my end gets cut out. I haven't seen that, so I'm assuming that I'm still okay here. All right, yeah, but let me know if anything like that happens, any technical problems happen like that, so I can make sure that I'm not talking to myself. I've done that before, where I talked to myself for 10 or 15 minutes and not realized it. It's not a fun feeling. All right, so we got a little bit of support there in the Russell. We'll keep an eye on that. Now, a lot of people have been talking about the bond market. And what's been weird about the bond market is that we're in this inflationary state where and the numbers we keep seeing are showing that there's inflation. Inflation is getting worse, and yet the bond yields, which would normally go up in that type of environment, are going down. And when yields go up, the bonds values go down, and so that, and the TLT is showing the movement of bonds. So this is when this is trending up, it means that bond yields are going down, bonds are going up, bonds are moving higher, and really the opposite should be happening. So what I want to point out here is that obviously the trend is still up. I've talked about this because this disconnect has been happening for a little while, as you can see. And I pointed that out, that, hey, we're still going to higher highs, higher lows, that it's still trending upward. That's what is actually happening. And that's what we want to pay attention to, is what is actually happening when we're trend traders. But we also want to recognize potential reversals. So we did get a move higher here yesterday on the TLT. But what I want to point out today is that this is a very strong bearish reversal today. This is a bearish engulfing pattern. I've done the trainings on this candlestick pattern in the past. Go back and review those. It opened up here, so it opened stronger and then completely engulfed the day before. We have seen bond yields rise today, and that could be a signal that we're getting a trend reversal in bonds. We'll see how that plays out. A couple areas to keep an eye on. This was the previous high that we just broke out of. If we break down below that, I think that'll be significant. This will really be significant. That was the last higher low. So if we break down below this, we'd have a lower low for the first time in quite a while. That would be significant as well. Now, we're not there yet, but that's going to be the next step, to see if there's any follow through to that bearish reversal day today. Now, bearish engulfing patterns, if they worked all the time or every single time, that's all I would trade, and I'd never do anything else. There'd never be any reason to do anything else. You'd make all your money on that pattern. There's no pattern out there that's perfect, that works every time. Could it shake that off and continue to go higher? Absolutely, and that's something else we'll keep an eye on in the next couple weeks as well, to see how that plays out. But again, I just want to point that out, that trend is still up, but we got a significant reversal signal today, at least if that holds. Again, we still have an hour and a half before the market closes. Maybe that changes, but it's not looking like it will. And we'll see if that leads to the bond market starting to decline and those bond yields starting to rise a little bit. All right, let's move on to gold. Now, one thing I point out with gold, I pointed out the last couple updates, is that we were in this downtrend. We were stair-stepping down. We had this impulsive move down. We had this little consolidation. Then we had an impulsive move down and then an impulsive move up. And since then, we've been kind of moving a little bit sideways. So this is acting like a trend. It could be a trend reversal. We need to see that next impulsive move up. We haven't seen that yet. We've still been kind of in the sideways range. So we'll have to kind of see what happens next there. I would anticipate that we have another move up, but again, as of right now, we're just kind of still in that sideways range, and as far as gold is concerned. Oil, now, I believe in the last update, we looked like we had this little pullback. It looked like we were going to break out, and I thought there's a really good chance that we'd end up breaking out higher. We had the very next day, we had a bearish reversal day, and then we've had this impulsive move down. Now, the tough part about this chart is that, typically when you have your ABC patterns, you get wave A, and then wave B is just kind of a bounce. It doesn't get all the way back up to the top, and then you get wave C. And so when this came all the way back up here, I don't know if this is wave A, wave B, wave C, and the correction is done and oil's going to resume the uptrend, or if this was a pullback, this was the top right here, and this is the start. This is an impulsive move down. This is actually a trend reversal, and we're going to see further downside of oil. So definitely this move over the last week has been impulsive to the downside. What we want to keep an eye on then, to give us a better idea of what the next move would be, is to pay attention to what takes place over the next few days. If you remember, when trends reverse, you tend to have back-to-back impulsive moves. So you kind of stair step up, you get impulsive, corrective, impulsive, corrective. When you get to a top, very often you'll get impulsive up, impulsive down, and then you'll get corrective and impulsive down, corrective. When you're at a bottom, you'll get impulsive down, impulsive up. Not all the time, but this is just general. Again, this is chart reading 101, the basics of understanding trends and how they tend to move. So if this is going lower, if this is an impulsive move down and we're in a trend reversal, we should see more of a choppy type of rally or moving sideways through here. It should look a little bit more choppy, more sideways. And that would tell us it's more likely to, again, doesn't tell us exactly what's going to happen, but it's more likely to continue to move lower. If we see a real strong bounce back in oil and it has more of an impulsive move up, then it would tell me that maybe this is wave A, wave B, wave C. This is the correction right here. So here's the impulsive move. This is the corrected move. And then you're resuming that uptrend at that point. You're more likely to be moving higher. So we just need a few more days to kind of see how that behaves to tell us what the probability there of the next move is. Okay. Now, this brings up another important point that I think is important, that is necessary, and that is that, remember, not every day, you're not going to have trading opportunities you can find trading opportunities every day. That's part of the problem. You can find something to trade every day. But, one thing things I talk about all the time is should you be trading? Should you be making a trade? Recognizing when the probabilities are in your favor. As I talked about last week or last couple of weeks, the trading environment was not real predictive. There wasn't a strong indication that the market was moving higher or moving lower. It was kind of, it could go either way. And those are always the type of trading environments where I lose the most money, is when it could go either way. And this is a situation right here where right now we don't have a clear indication of where oil is likely to go. We need to wait a few days to see how it plays out. If it's more choppy, more sideways, I would say the stronger probabilities there's more downside. And again, we're talking probabilities here, not absolutes, but the stronger probability is you're not done yet. You probably have further drop. If we get a real sharp, impulsive move up, it probably means that oil at least is going to try to move back up to its previous highs. And you could trade that accordingly. Now, I know there's lots of opinions out there. Everyone's talking about how the oil supply is increasing now and that the oil rally is done. And there definitely are fundamental reasons that you could be bearish on oil. But remember, the chart is what people are actually trading, and typically it's what the professional traders are trading. And so I tend to lean a little bit more towards what is actually being traded as opposed to what the opinions are and all the reasons out there that people give. And so, as of right now, it's not real clear. We'll see if that gets a little bit clearer by Thursday or even into next week. The dollar, again, trending up, but it had a bearish reversal day today so far. You have higher highs, higher lows, went to a higher high today. But we opened up here, and it looks like we're going to close down here. So this is one of those situations where we might close lower than where we opened, but still higher than the day before. That's always a bearish reversal signal. It's a short-term signal, so it could just mean that it pulls back a little bit. Maybe it just pulls back and fills in this gap. Maybe it opens down here and then continues to go higher. But it could also mean that the dollar's in a trend reversal. It starts to trend lower. Again, the key spots you'd want to look for right here. You had kind of a double top right here before it moved higher. If it moves down below that, that would be an early bearish signal that it moved below those lows. This is the last significant higher low right here. This is a little higher low, and we could pay attention to that one as well, because obviously it would drop below that on its way to dropping below this low. But that would really tell you that the trend reversal is underway, is if it gets all the way down and drops that lower low. But we'll see if the dollar pulls back a little bit off of that, just that little bearish reversal candle. And then the VIX, one thing I told you to watch for the VIX, I mentioned this a week or two ago, might have been just a week ago, but during this whole decline, notice how whenever we've had these little spikes in the VIX, they've ended up being lower highs. Here's a little spike right here. There's a lower high. There's a little spike right here. End up being a lower high. I said, watch to see if we end up spiking to a higher high. We did that yesterday. Now, I also mentioned when I talked about that it doesn't necessarily mean that that's the end of the world or we're getting a larger correction right at that moment, but it could signal that we're near that top, that we're starting to see volatility trend higher. We're starting to see higher highs. Obviously, we're down again today on the VIX, but maybe if the market pulls back again, we want to look to see if it spikes to a higher high again, and we start seeing it trend higher, because that could tell you that a larger correction could be underway or could be happening as we start to see volatility start trending higher there. So we'll keep an eye on that over the next little bit. And then a couple I've added, I did a trading on this last week, was I like to look at again, this is like the VIX. It's not going to tell you something every day, but you want to look at semiconductors versus the NASDAQ 100. Semiconductors had a nice bullish reversal day yesterday, where we gapped down. We opened at the lows of the day and ended up closing higher than where we opened. This is opposite of that. Although we ended up going positive here. We weren't, but if we would have closed a little bit lower, we would have been higher than the open, but still lower than the day before. Here we actually did come all the way back up and close higher than the day before. That was a pretty strong bullish reversal candle. Not surprising that we were up today. Now we had a much steeper sell-off in the chip sector. And so what you want to look for here is, is the SMH moving up stronger than the NASDAQ 100? We look at the QQQ. And again, this will be something we'll keep an eye on over the next few days. It's not going to necessarily be something we'll read immediately. It's not really telling me anything today. The Qs are up and the chip sector is up. The chip sector, again, sold off a lot more. But what I'd like to see is there a little bit stronger? Is there more of an outperformance if we do rally up from here? Do we see the chip sector really kind of lead the way? And it's a little bit too early to tell, but that's something we can keep an eye on as well. And then the transportation stocks, the Dow Transportation Index, the IYT, you want to compare that to the Dow Industrials. We talked about how the transportation's stocks peaked back here in May. We've been declining pretty steadily since then, where the Dow index has been moving a little bit more sideways and almost went to a new all-time high. We'd want to see transports outperform the Dow Industrials. If the rally back up is strong, you'd like to see that. If it lags, if it continues to lag, it'd be a sign not to trust the rally as much. And again, it's still a little bit too early to tell on those. All right. Boy, I'm really lagging on time here. Let's look at a couple of stocks here. Well, part of the problem though is that a lot of these updates, there's some days where there's not a lot to talk about, and when you have a day like yesterday, there's a lot to talk about. There's a lot I can teach you, and so I want to take advantage of that. So if it seems like the update part is running a little bit long, hopefully it's been valuable and you've learned something, and makes up for some of those days where there's not a lot to talk about. All right, so individual stocks, let's look under business services. 95 strength rank here, this SSNT. Let's switch this back to signals here. And what I'm looking at here is it looks like this could be an ABC correction. It's a pretty deep correction here, but it's kind of pulled all the way back to this consolidation range. You'd want this to rally up, go back to that buy signal as confirmation, because obviously this thing has dropped quite a bit over the last couple of weeks. And then if you do get that buy signal, if it does rally up from here, you've got this range, like I said, and that would be, this would be a good area for a stop. If it goes up from here, it goes back to a buy signal, or even down below that range. If you want a little bit of a wider stop, it shouldn't go back below here. If it does, you'd want to be out of the trade. Under the retail sector, nice thing about these market pullbacks though too is it gets us some new stocks that come into these sectors, so we're not always looking at the same ones every week. This Lands End, LE is the ticker symbol, 95 strength rank. We'd like to see it up in that 98, but there's not anything I like in the 98. I'll move down a little bit, but this one looks like it's pulled back a little bit. This could be wave A, wave B, wave C, but this is very similar to what I showed you on the oils chart. I don't know if that's wave A, wave B, wave C, or if this was the correction and that was the top right here, and this is starting a trend reversal. Again, we're waiting for confirmation. This to go back to a buy signal anyway as confirmation, but you also want to see how it goes back to that buy signal. If it starts to move sideways, choppy, like right through here, then it's maybe more likely this is the start of a move down. This could be in a trend reversal. That's the correction, and it could have another impulsive move down. If it moves up pretty sharply, there's a pretty good chance that this is wave A, wave B, wave C. If it moves up sharply, goes back to that buy signal. That could be a good entry point. What I also like about this, you've got this bull move right here, and we've had broken out of that bull, and then we pulled back. What I like about these bull moves is when they break out, there's a tendency for them to move up the same distance as the top of the bull, the bottom of the bull. Now, they don't always do that, but they do it enough to where traders recognize this and try to trade that pattern. It's called a cup with handle pattern. This is the cup, and then you usually have a little bit of a handle. We don't have much of a handle here, but maybe we see that. Maybe it moves sideways here for a little bit longer, and then breaks out again. But there's that potential for this to have a pretty big move that can break back above that top of the bowl again. And actually, this one, if it goes back to that buy signal, it might be pretty close to breaking back out above that bowl. You could wait for that as additional confirmation to enter trade. Maybe it goes back to a buy signal just before it, and you wait an extra day or so for it to get back above it to get in. Those are decisions you can make as well. I also liked this HIBB Hibbett Incorporated 95 strength rank. Similar kind of situation here where it looks like we put in a higher low right there. We've recently broken out. A nice up day today. It could be that this was kind of your ABC right there, wave A, wave B, wave C, although that would be what we call a little bit of an irregular ABC pattern, which is a little bit rare. Now, like with the other indexes, it could just be that this is the correction right here. You're just getting there's just a real sharp correction that goes right back up again. That doesn't happen very often, but we've seen it happen recently to where that might be what ends up taking place. The key is going to be this low right here. If this goes back to a buy signal from this move today, you could use that as a stop loss. You could also go back to this low as a stop loss to give you a little bit more room. Let's go to computer and technology. This AVID 96 strength rank. And again, notice, this is clearly impulsive. This is clearly more choppy, more sideways. It looks like wave A, wave B, wave C. But just the behavior of it, it's more corrective looking, which would lead me to assume that it should resume. Once that sideways movement is done, it should resume the uptrend. You'd want to wait for it to go back to a buy signal. And if it does, you could use these low. There's a lot of support right in this area here that you could put a stop down below those lows. Another one in computer technology. This is one I've been watching for a little while, but GSAT. I brought this one up before. Now it's come down a little bit deeper now than before. When when it pulled back right here and started to move up, that's where I liked it the first time. It's come down again, but it hasn't. There's still a little bit of support right here. It's still technically higher highs, higher lows. This was the last significant low, a higher low there, kind of an even high right here, but it went to a higher high after that. Here's a higher low. Came down from a decline, so it could kind of be turning the corner back up again. It's kind of in a real critical spot though. And on the virtual trade we did on this, I did use this area down below here as my stop. So I'm still in the trade in the portfolio. This is the practice trade portfolio there. But when I was going through and teaching about how to set that up, I used a stop below that low. I'm going to talk about stop losses today here in a second with the few minutes I have left. And the key thing to always remember about stop losses is there's no perfect place to put a stop. And kind of the guiding philosophy that I like to use for stop losses is that I always try to put my stop loss at a point where I feel I'm wrong on the trade. And that position can be different. There are some times where I'm going to give the trade a little bit more flexibility, a little bit more leeway because, I may, and this is a good example of that. you know, the overall view, the overall look of this is that it's reversing into an uptrend. Now, we had started to move up right here when I got in this trade. I could have used this real tight stop right here, this low, previous low, as my stop. And if that was the case, I didn't lose very much money because it would have stopped me out. I didn't lose very much money. I could always get back in. And so that's the benefit of a tight stop is, hey, I don't want to lose a lot. I'm expecting it to go up from here. If it doesn't, I don't want to lose a lot. I'm going to keep my loss real small. I can always get back in again. And there are times where that's my philosophy. That's how I want to trade is use a tight stop. I can always get back in again. But there's also, if I feel like generally the trend is starting to move back up, this was the previous higher low at that point. The last significant higher low was right here. This would give me a little bit more flexibility for getting this trend right. But I would lose a little bit more money if I'm wrong. Again, there's no right answer here. It just is kind of a matter of I don't want to be jumping in and out of things. I think that this is eventually going to move higher, and I want to give it enough room to do that. And who knows? That still, we had a bullish reversal day yesterday, but it could, we had a bullish move back here and it reversed, so it could ultimately come back down and stop me out. This stock is cheap enough too, where you could decide you're not even going to use a stop. But remember, we talked about that with position sizing, and this was the training last week, I think last Tuesday. Go back and review that. I'm not going to repeat all of that here, but if you're not going to use a stop, you've got to be aware that you're basically risking everything that you're putting into that trade. So, if you're willing to risk $1,000 or $2,000, then you're probably going to buy, you're probably the amount of shares you're going to buy is going to be limited by willing to risk that entire amount. But this stock is cheap enough to where, what's your downside at this point? It's either going to go out of business or it's going to go up from here. And so, I wouldn't fault anyone for getting into a trade like this and not using a stop. Willing to risk, but you have to be willing to risk that entire amount. Let's see here, just real quickly on the finance sector. This ATLC, a 95 strength rank. Had a nice bullish day today. A little bit of a consolidation through here. Here's a breakout area. So it's kind of bounced off a little bit of the support area right there. Nice thing about these more sideways type consolidations is, again, if we break out above here, and that's probably when you get your buy signals, would be on a breakout, or we're probably pretty close to going back to a buy signal. You could wait for it to break out as that additional confirmation, but out of those sideways ranges, the stock tends to move up about the same distance as the top of the range to the bottom of the range. That gives you kind of a target expectation. And then one more, this XYF. Again, looks like this could be wave A, wave B, wave C of a correction. It's retraced about 50% of that move up, about half that move up. It's down today though, with the market being up. So you'd want to definitely wait for a confirmation to go back to a buy signal. Think about ABC patterns is it could also be that you're in a downtrend and you get a bounce and you go lower and you're reaching lower highs, lower lows. usually the key again is what when you think you're on a C leg, when you think you're in wave C of an ABC correction, you want to pay attention to how it rallies. If it's more choppy, more sideways, it's probably going lower. If it reverses sharply, you have this impulsive down, then you get impulsive up, and then you get more of a sideways move. It's more likely that you're resuming that uptrend. All right. As I mentioned, and again, we've kind of been talking about stops along the way here and looking at these individual stocks. I'll go back and look at a few of them. There's a lot of different stop losses that you can use. Some people use percentages. You know, if the stock drops 10% or 6%, you know, whatever that percentage is, 50%, I'm going to stop out. If I lose half of what I have in the trade, I'm going to get out. Again, where you place your stop, it ties into what we talked about last Tuesday with your position sizing, how many shares you're going to be buying, how much you're risking, knowing what you're risking the trade. The two things that you can control in a trade, a lot of things out of your control, but you can control where you place your stop, and you can control the size of your position based on where you place that stop. And so those things are critical. And like I said, there's not a perfect stop loss point, but if you go by that guiding principle of placing your stop at a point where you know that you're wrong, that's usually a good start. Now, obviously, the next question would be, well, Jerry, I don't know anything about charts. How do I know I'm wrong? Well, that's part of what I want to show you today, is to give you a couple of ideas of how to recognize when you might be wrong. One of the most obvious that you see me do is this ties into the basic stair step of how stocks move. Stocks tend to kind of move up in a sharp motion. They pull back in kind of a choppy corrective move. And you kind of get this stair step, higher highs and higher lows. That's the behavior of an uptrend. So it makes sense that if that's how uptrends act, higher highs, higher lows, well then, if you suddenly go to a lower low, that could be a signal of a trend reversal. And if that's a signal of a trend reversal, that's where you know that you're probably wrong. So to put a stop loss below a previous low is one of my favorites. I do it all the time. Now, I think it's important to understand, though, that there are millions of people out there that know how to read a chart. And again, you know, when you're learning charts for the first time, it's pretty amazing because you don't recognize what all this chaotic stuff that actually can be. You could actually make sense of this chaotic price action, and it can actually predict some things. It gets exciting, but you know, and I teach a lot of beginning traders a lot of times in these updates, and I get comments like, "This is amazing stuff," and I remember I like that because I remember that feeling when I learned this stuff the first time. But I'm not a genius. I'm not a market psychic. I'm not the smartest person in the world. There's thousands and thousands and thousands of other traders that are seeing the same things and recognizing the same things. And you're going to be one of them when you get all this down. You're going to get to a point where it's like, yeah, that Jerry really isn't that smart. He just knew how to recognize this stuff, and now I know how to recognize it. I don't need him anymore. You're going to get to that point as well if you put the work into it. But I think it's important to recognize that you're not the only one seeing that this is a point where you know you might be wrong. Why is that important to understand? Well, because sometimes stocks will trade down to these lows and they'll dip down below them just temporarily to stop everybody out, and then they come right back again. And so when I set my stop, sometimes I'll put it right at it, especially if I'm going down to if like on that one stock where we were stair stepping, and it looked like it was starting to move back up, but this could be wave A, wave B, wave C. Maybe you come back down a little bit lower. I put my stop down below here. Well, I put it real tight at that point, right below there, because if it did go below this low, and then drop even barely below that low, you're probably in a trend reversal at that time. But you can also decide to put your stop down just a little bit lower than that low. So if this is at $50 or something like that, maybe you drop your stop down to 47 just to move it a little bit lower, so that you're not, because there's a tendency to put it right below it, and there's a lot of people that do it. So that's what I'm saying. Professional traders know this, and their computer programs know this. They're programmed a lot of times to kind of move prices down to these levels where there's a lot of stops, stop all these people out, and then move the price right back up again. Now, you're always going to be in danger of having that happen to you, where it stops you out and goes right back up there. I can promise that's going to happen to you at some point in your trading career where it does that. But to try to keep it from happening too often, you could consider putting your stop down a little bit lower than that exact low or exact point right there. Another stop that I like to use is based off of Fibonacci retracements, and basically the philosophy of the Fibonacci retracement is that stocks will tend to retrace about 50% of their moves. Now, it can be a little bit more than that, and so you could set a stop based on that retracement zone. For instance, if we were to put in our retracement zone, so I talked about how this stock looks like it's retraced about 50% of this move up right here. We can put in the Fibonacci retracement tool. And let's highlight this area. I also have a training on how to use the Fibonacci retracement tool. You can go back and review that if you need to. But remember, the concept is that stocks will tend to retrace about 50% of their moves. But the key word there is about. There's a little bit of a range that we look at. Sometimes it can be a little bit less than 50%, or the 382 Fibonacci level, 38.2%. Here's the 50%, which is what the concept is based on. And the retracement could be a little bit deeper, 61.8%. We call this the retracement zone. It's kind of like a strike zone in baseball, you know. Stocks will tend to pull back to this zone, and then they tend to move higher out of that zone. You could put it right below 50%. You know, but a lot of people will put it below the zone, put it below 61.8%. Now, the Fibonacci tool tells you the dollar amount of where that 6618 retracement is, that 61.8% retracement is, $8.43. Maybe I put my stop in at $8.42 or now this is one where you could put it a lot tighter, like right below it. Just because it's not real obvious. There's fewer people that know about Fibonacci retracements and Fibonacci retracement zones, or even that base their stops on retracement zones. So it wouldn't be as obvious to have a stop right in this area here. I don't see any other support or resistance there that would be screaming a stop to stop out of the trade. So you could make that a lot tighter right there if you wanted to. But that's a stop loss that you could consider is using that retracement zone. Now, remember, I was saying we want to wait for this to go back to a buy signal, particularly on the down day it had today. This thing can blow right through that retracement zone, and we may not even want to consider this for a trade in the next few days if it were to do that. But if it did go back to that buy signal and you wanted to use that as your stop loss, that's another stop loss technique you could use. And this one again is less obvious, so but it would make sense, you know, if you know that stocks when they pull back, tend to pull back about 50% of the move. And it looks like it goes longer than that. Then you know you're probably wrong, and it's a good time to get out of the trade when you know that you're probably wrong. Now, one technique I like to use for a really tight stop, and I usually use this for option trades because in an option trade, it doesn't take a very big move of the stock to cause a big move of the option. That's why I like options. Is I could get if I buy a call option on a stock, it could move up just a little bit. I get a 50% gain on a real small move of the stock. I get a 50% gain on my option. But the opposite is true too. You can get a move against you, a small move against you that could cause a big drop in your option. You can't go more than what you pay for your option. You can't lose more than what you pay for the option. But if I bought my option for $2, you get a small move down, and that option would be worth $1 real quick. It could lose 50% of its value very quickly. So a lot of times you'll need a little bit of a tighter stop. And one that I like to use, let's go back to CSAT here. So then let me flip off the signals here. Let's go to candlesticks. So back here, we had this pullback, and it was starting to move higher right here. And let's say I entered my trade off of this move right here. It kind of pulled back, and then it looks like it's starting to move higher. One real tight stop that I like to use is to stop out if the stock closes below the low of the previous day. Now, make sure you understand what I'm saying there. Not close lower than the day before. That's not what I'm saying. I'm saying it closes below the low of the previous day. And another keyword there is closes. Not trades below the low, but closes below the low of the previous day. Now, this means that this stop loss will probably be something you'll be looking at the end of the trading day. So with a lot of my option trades, I'm doing things a lot of times in that last 15 minutes of the trading. I'm really busy that last 15 minutes of the trading day because I make a lot of buy decisions and I make a lot of sell decisions, at least as it relates to options during that period. Well, obviously this trade wouldn't have worked out. It didn't go up from here. How would I have known? When would I have gotten that signal to stop out? Well, it moved up the next day. Then it moved down the day after that. But here was the low of the previous day. It didn't close below the low of the previous day. And so you don't want to get bounced out. Just because you have a down day doesn't mean it can't keep going higher. So you don't want to get just bounced out just on a day that's moving lower. This didn't necessarily signal that it had to drop from here. The next day, though, it did end up closing below the low of the previous day. There's the low. Here's where it closed. And that would be a signal that I was wrong. Because typically when you're in these moves higher, you're not going to close below the low of the previous day. Let's look at right here. When did we close below the low of the previous day? It wasn't until right here. That was the first time it closed below the low of the previous day. Here it traded below the low of the previous day, but didn't close there. It closed right up here. Well, look at where that happened. That happened right when it started to decline. Now, again, this is a real tight stop. It doesn't mean that the first time it closes below the low of the previous day that it's going to collapse. Doesn't mean it can't come right back up again. But typically, when it closes below the low of the previous day, it's telling you that rally that particular rally that you're looking at is probably done. And now, by the way, you can use this as also an entry technique. This, like I said, this looks like it's maybe forming an ABC pattern right here. I could look for a close above the high of the previous day. It hasn't done that during this whole drop. Here was the high of the previous day. Here's the high of the previous day for that one. Here's the high. Here had a bullish reversal day, but didn't close above the high of the previous day. Now today, we're right at the high of the previous day, actually a little bit below it. So it may not close above the high of the previous day today. Maybe tomorrow it does. And that could be your entry signal. That could be a real, that's a real quick entry confirmation to get into a trade. And by the way, the quicker or the smaller the signal, the more unreliable it can be. But like I said, in a situation like with an option trade, you have to have a real quick signal. Otherwise, by the time you know you're probably wrong, your option's worthless because it lost all of its value. So anyway, those are a couple techniques. Just thought I'd throw those in there. Again, just to recap, you can use, if you're looking at the stair step, you can look at use the previous low or even the one before that as a stop loss. You could use a Fibonacci retracement, use that Fibonacci retracement zone, hit it below that retracement zone as a stop loss. You could use a close below the low of the previous day as a real tight stop loss in some situations. But again, the key is to put that stop at a spot where you know that you're probably wrong. All right. Thanks, everyone. Hope that was helpful today. Sorry we went a little bit long. Like I said, we had a little bit more to talk about today. And we'll see you on Thursday for the stock-specific class. Bye now.